Everybody tells you to invest your money, but most people don't tell you what to actually do. So in this video, we're going to go over where to start and how to invest for beginners. We'll start with the basics, and then we'll get to a couple of advanced topics at the end. And whether you're starting with $50 or $5,000, the framework and the process is the same. When most people talk about investing, they're talking about investing in the total market. But how do you actually do that? And that's where ETFs come in, or exchange traded funds. So what ETFs are, they're basically one bucket that you can buy like a stock, but they cover a lot of stocks at once. They typically track an index like the S&P 500 or the NASDAQ or some international markets, and you're able to buy all of them in one place. And they're also typically passively managed, which means the cost of owning them is very little. The cost of owning an ETF is known as an expense ratio, and it's expressed as a percentage, which is how much it costs you of your initial investment to hold that every year. Now, these are typically pretty low, like in the 0.03 to 0.1%. And that doesn't sound like a big difference, but over the course of years, with compounded growth, it can make a sizable dent into what your portfolio is worth. A good example of this is the ETF VOO versus the ETF SPY, which both track the S&P 500. But SPY has an expense ratio that's 3 times higher than VOO. It's 0.09% versus 0.03%. Now, if you already hold a lot of SPY, doesn't mean you go off and sell it, because that will trigger a lot more taxes than just holding it and letting it run. But you can change your future contributions to VOO to take care of that. So what are the major ETFs that most people recommend? Well, for the US market, there is VOO, which tracks the S&P 500, which is the 500 biggest companies in the US stock market. SPY also tracks the S&P 500, and it's better for short-term traders because it offers more liquidity, but it has a higher expense ratio. So for most long-term investors, VOO is the better choice because they track the exact same things. VOO is just cheaper to hold. Now, if you want more than just the S&P 500, you want the entire US market, then you could go for VTI, which is the Vanguard Total Growth Index, which tracks roughly over 3,400 US companies, including everything from small cap, large cap, and mid cap stocks. So if you want international exposure and you don't want to just be trading in the US market, there are 2 great options. The first is VT, which is the Vanguard Total World Index, which includes everything from US stocks to international stocks. This is a great one if you just want to pick one stock, or one ETF. You don't have to worry about allocation between US and international, and you just want to buy one and let it sit. Now, the other option is VXUS, which is everything international excluding the United States. It's also managed by Vanguard. And this is, let's say you want 70% US allocation and 30% international allocation, then you would buy 70% VOO with your money and 30% VXUS. Now, there are also some ETFs that give you dividends, or they pay you for holding them. And the biggest one is SCHD, which is managed by Schwab. So what this one does is it manages roughly over 100 US companies that have solid earnings and solid histories that also pay out big dividends. So it'll pay out dividends at a higher rate than holding VOO or SPY or VTI. But as a trade-off, its growth potential isn't as high. But if you need the income right away, then SCHD is a good option. Now, if you're looking for more growth potential, like stocks that have a higher chance of gaining value, but with a little bit more risk, then the ETF for that is also managed by Vanguard, and it's called VUG. And this one looks at more stocks that have a higher growth potential while also taking on a little bit more risk. This one can make a lot of sense, especially if you're younger and you're able to take a little bit more risk because you can wait out any market downfalls. The whole point of buying ETFs, especially for people starting out, is diversification. Or instead of putting all your eggs in one basket, you're spreading them over a lot. Now, with ETFs, you're automatically buying into hundreds or thousands of stocks at a time, so you don't have to worry about manually picking all of them. And over time, diversification is meant for different asset classes as well, like stocks, bonds, real estate. But as a beginner, most people are well served by just picking 1 or 2 of the ETFs we talked about before and letting it run. Now, there's also the option for geographic diversification, which is where those international ETFs come in. Now, over the past few years, the US stock market has outperformed international companies, but that's not always going to be the case. So it is a smart idea for some people to put some in VOO and some in VXUS, so that way they're hedging for both opportunities. Now, diversification is not buying 5 ETFs that all cover the same things. That's just buying 5 of essentially the same thing and thinking that you're diversified. So you should look into what the overlap across ETFs are before you duplicate and buy 2 different ETFs that are essentially holding the same thing. So let's take a look at some high overlap examples and some low overlap examples as well. So the first big high overlap is VOO and SPY because they track the exact same index. So they virtually have the exact same performance. So if you hold both, you're not really gaining any extra diversification. You're just doubling down on the same bet. Now, VOO versus VTI, which is the total US market, it may sound like VTI has a little bit more diversification, but they're weighted by company performance. So by weight, VTI has roughly 82% of the exact same overlap as VOO. Now, this is also true for, let's say you're considering doing the international market and you have VT versus if you're holding VOO plus VXUS. Now, it makes sense to do either one of these, but if you do both, again, you're having the same overlap because VT holds the exact same companies as VOO when you add it to VXUS. Now, there are also examples of low overlap ETFs. The biggest example is VOO and VXUS. When paired together, they have virtually no overlap because VOO is the US stock market, top 500 companies, and VXUS is everything outside the US stock market. So they make a good pairing if you want to hedge for US and international growth. Now, another good combination is any of the VOO, VTI, SPY, and SCHD, because even though they hold some of the same companies, they have a different balance of allocation and they have sort of different purposes, where VOO is more of just a long-term growth play, and SCHD is a short-term income generating as well with the dividends that it pays. Now, a third example is picking one of the US or international ETFs and BND, which is a bond ETF. So a bond is any time that you lend the government or some entity some money and they agree to pay it back to you. And instead of going through that process, you can buy into this ETF so that way you have a little bit more of a guaranteed return, which can help you out in time of a recession, or if the market's going sideways, it can help keep your portfolio stable. Now, overlap isn't always bad, but holding 10 ETFs that all hold the same thing isn't doing what you think it is. So before making decisions on what to buy, you can always go online and look at a free ETF overlap checker just to see what's actually in what you hold before you buy it. Now let's understand how compounded interest applies to the investing methods that we just talked about. Compound interest is when you hold money for a long time in the market and every year it returns and those returns compound on each other to give you an accelerated growth of wealth over time. Now, the biggest lever in compounding is time. The amount of time you spend in the market will always beat timing the market, which means trying to find the lows to buy into and the highs to sell into. Over time, if you just hold long term, you will outperform people that are trying to time the market. Now, just as important as time is leaving that money alone once you invest it and not touching it. And the easiest way for most people to achieve this is by automating the process through dollar cost averaging. This is where either every set period of time, let's say it's every paycheck or every month, you automate some amount of money to go into your brokerage account and you just buy one of these ETFs and you let it run. So it's very important that you hold through crashes as well, because the market is not always going to go up. And when the market crashes, people are tempted to sell. But what happens when you sell is that you lock in those losses. And then by the time the market recovers and you decide, oh, I want to get back in again, you've lost out on all those gains. Now, to be clear, this holding through crashes logic applies to ETFs, because for you to lose money on these long term, the entire US market or the entire world market has to crash. It does not apply to just individual stocks, because individual stocks have gone out of business and have gone to zero. So holding in a crash for an individual stock is not as safe of a bet as holding through a crash for an ETF, which is actually necessary for the strategy to work. So compounding is not a get-rich-quick tool. It takes time, and the more time you give it, the more that it's able to accumulate your wealth. And most of these gains are going to come in the back half of that time. At the beginning, you're building that runway and that snowball, and at the end, it really takes off and you start seeing the results. So now let's take a look at some basic tax information that you should know while investing. Now, this tax information is current as of this video being live, but the tax code can change. So you should check with a professional or check the tax code to see if there have been any changes since this video. So the first thing you should know about is short-term capital gains. This is typically when you buy a stock or an ETF and you sell it within 1 year of your purchase date. If you do, then any gains are taxable at your income tax bracket. So whatever your income tax bracket is, let's say it's 22%, you would pay that same income tax on these gains. Now, there's also long-term capital gains tax. So this is if you hold a stock for a year or longer and then you sell it, then all of the profit that you've made is taxed at a capital gains rate, which can be either 0, 15, or 20% depending on your income, but it'll be lower than your income tax rate. Now, because dividends get taxed, they create a tax drag in your normal investment accounts because you have to give some of your gains back to the government each year. Now, this is where the account that you invest in matters, because if you had accrued these dividends in a tax-advantaged account, like one of the retirement accounts or health savings account, then you might not pay taxes on it at all, or you won't pay taxes until you withdraw your gains all at once. And if you want a bigger breakdown on all these different types of accounts and all their use cases and how it applies to you, I have a video coming out on the channel in a couple weeks that will cover all of that. So now we've got through the basics. We're going to take a look at a few advanced concepts. Now, if you're a beginner or even an advanced investor, you don't need any of these advanced strategies and concepts. Most people will perform just fine by just buying one of the standard ETFs and letting it run for a long period of time. But that said, these advanced strategies exist if you want something to keep investing interesting and if that's what keeps you consistent. So the first thing we'll look at is investing in individual stocks. Now, this can be good, especially if you're young, when you have time to hold through a crash and for your money to recover. And there is a lot higher upside to investing in an individual stock versus the entire market, but there's also a much higher risk. Now, calculated risks can pay off, but there's a few things you should keep in mind so you're not just blindly throwing money away. The first is to not just blindly buy any stock that you see on social media, because there is some genuinely good advice out there on social media, but there's also a lot of people that don't know what they're talking about and just giving advice. So you should research any individual stock you buy before you buy it. Good rule of thumb is if you can't explain what that stock is and why it's part of your strategy, then you shouldn't be buying. Now, the second thing you can do is put something called a stop loss. So let's say I buy an individual stock for $100 and I set a stop loss at 90. That means that the system will automatically sell if the price goes below 90. But something to be careful of is a lot of companies report earnings after hours. And that means that you might see a big swing after hours. So let's say I bought a stock for 100 and the company released its earnings. And in post-trading hours, after the market is closed, it dropped to 80. Now, as soon as the market opens the next day, my stop loss is going to trigger, but it's going to trigger at $80, not $90. So a stop loss is a good way to limit your losses, but don't think of it as a guarantee that that's the most you can possibly lose. Because there is a much larger risk with investing in an individual stock, don't put more than you're willing to completely lose. If it's an amount of money that could change your life or really affect your life, then it's too much to be putting into any one individual stock. Investing in individual stocks, especially when you're younger, can be a good tool to take some calculated risks. And for most people, it's good because it keeps them excited enough to continue investing. But this shouldn't be your whole strategy. You should keep it to a small percentage of your portfolio and let your vast majority of your portfolio still be the safe market indexes that have proven to make people wealthier over time. It's also important to note that the market is full of a lot of very smart people with a lot of very advanced tools. So the chances of you being successful doing something like day trading is very low. And historically, most people that just buy one of the biggest S&P 500 ETFs and just hold perform better than people that do a lot of individual stock betting. So think of this as a tool to take some calculated risk when you're younger, or just keep that excitement alive so that you're willing to stay the course with the main plan. Now, the second advanced topic is bonds. So a bond is any time that you loan some money to either the government or a bank, and they agree to pay you back with some interest. Now, you can buy bonds either directly from the government through treasury bonds or through a bond ETF. And the general advice for most young people is that bonds aren't worth it because they're going to give you a lower interest rate than the market averages. So there's no point of sacrificing that growth when you're young and you can recover from a market crash by buying bonds. But bonds do have a place psychologically for some people because a lot of people can't stomach seeing that their portfolio drop by 10% or 20% in a crash. So knowing that some of their money is safe in a bond can actually help people stay the course. So if this is you, having a small percentage of your portfolio allocated to bonds could make some sense. And as people get closer to retirement, they tend to invest a little bit more in bonds because now they don't have time to recover from a crash. So if there's a crash that happens 2 or 3 years before they retire, then all of a sudden they don't have time to recover and their retirement gets delayed. Now, the last advanced topic that we're going to cover today is gold. And instead of buying physical gold, you can buy gold ETFs. The two major ones are IAUM and GLDM, which let you hold gold through an ETF. Now, it's important to note that these are taxed differently because they're considered collectibles by the IRS and not real stocks. So they can be taxed at a rate of up to 28%, which is higher than the normal capital gains rate. Now, again, for most people, you don't really need gold in the portfolio, but some people buy it for the same reason that they buy bonds. As an inflation hedge for when the market goes down, or if inflation creeps up, gold tends to hold its value. So some people will hold gold just as a hedge, or just to have that psychological security that if the market is crashing, some of their money is safe. Now, it's important to note that gold is not an income producing asset because it doesn't give you any dividends. And the whole purpose of it in any portfolio is just a hedge. And this comes to a broader concept of if you don't fully understand something or you can't fully defend why it's in your portfolio, you shouldn't invest in it. And this applies to crypto as well, which can make sense in some portfolios, but it's very volatile and it doesn't make sense for beginners unless you really understand what you're doing. So the main takeaways from this video is that investing is how you can accelerate your wealth building and put your money to work for you instead of letting it sit around and lose value to inflation. Now, you don't have to know everything when you start, because if you wait for the optimal solution and you waste days, those are days of compounding you won't get back. For example, when I started investing, I didn't know anything about expense ratios, and I bought a lot of SPY without realizing that it had a higher expense ratio. But as I kept investing, I learned more, and now I've made that change in my portfolio to start investing in VOO instead. Now, in most cases, trading slightly suboptimally is better than not trading at all, because trading slightly suboptimally right now beats waiting 3 years and then starting later. Now, to be clear, suboptimal does not mean doing things like day trading or betting on individual stocks for the majority of your portfolio. Here, it just means picking one ETF without really fully understanding all of the jargon, like expense ratios and the tax rules, but just picking one and starting. You might not know everything when you start, and that's okay. You can learn as you go. But the biggest mistake people make is not picking the wrong ETF. It's not starting at all or waiting too long to start, and now they have less time for their money to compound and grow. So today, start with whatever money you have and automate it, even if it's only $50 a month. Just automate it to build that habit. Investing doesn't have to be complicated. You can just pick 1 or 2 of the ETFs we covered in this video and set them to auto-invest every month or every paycheck. And if you just do that, you're already building the habits that you need to build wealth long term. Now, as you get a little bit more comfortable with investing, you should look back at this video and try to understand the things like the expense ratios, the tax treatments, and be able to defend everything that you're investing in. Know what place it has in your portfolio and why you own it. If you could explain that to somebody, then you're probably doing something right. Now, the advanced stuff we talked about in this video, the bonds, the crypto, the gold, the individual stocks, for most people, it's not necessary at all. And if most people just buy an ETF and let it run, it'll do very well over time. That stuff is just there for people that have specific situations that make sense to buy one of those things or invest in one of those things. But you should do your research before entering any of those fields, because with things like bonds, you're sacrificing potential growth. And with things like individual stocks, you're taking a much higher risk in terms of potential losses. If this helped you, consider subscribing, because I post content like this every week. And in a couple weeks, I'll be posting a video that goes over all of the different types of accounts that you can use while investing and all of the tax rules related to all of those and how they can be best used for your scenario.